Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find over 450 blog posts and over 450 links by now to my YouTube channel. And I wanted to talk about a recent blog post I did, what a red hot stock market teaches us about shareholder returns. So it's summer of 2021. The S&P 500 is near a record high. It's up 36% in the last 12 months, which brings me to a question. How much are you earning as an investor on your stock investments? Because after all, you're investing for some goal, save for a house or plan for retirement. So what's a reasonable rate of return, and how do you figure out what you're earning? So generally speaking, there are three ways to earn a return on stock. One is price appreciation. You profit from the stock going up above the price that you bought it. That seems obvious. The second is a cash dividend. The company pays you a cash dividend, which is a share of company earnings. And then the third way, which is often forgotten, is a stock dividend, that instead of receiving cash, you receive stock, additional shares of stock, and you can benefit from a price increase or a cash dividend on the new shares as well as the shares you already own. And the big driver of shareholder value is earnings per share, or EPS. A lot of different definitions and tweaks on this, but it's generally net income available to common stock, that is, to common shareholders, divided by average shares of common stock. In other words, how much did your company earn in terms of profit on each share of common stock? And we use common stock specifically because in some cases, if there is preferred stock outstanding, the company may pay a preferred dividend before a common stock dividend. So a simple example: if Premier Manufacturing earns $5 million, average number of common shares outstanding are 2 million, earnings per share, EPS, is $2.50. The way you determine if that's good, bad, or average is you look at industry averages. And another factor we can use to figure out rates of return for shareholders is earnings yield, which takes earnings per share and divides it by the market price of the stock. In this example, it's $2.50 EPS divided by a $60 market price, 4.2% with rounding. So this answers the question: when you buy a stock, what type of yield are you earning based on the price that you pay for the stock? And I make the point that at an all-time high, when the price you pay for a stock is higher, the earnings yield is lower. Now we need to talk about dilutive securities. Dilutive securities increase the number of shares outstanding, and there's two of the most common examples: convertible bonds, bonds that can be converted into shares of stock; stock options, a security that allows the holder to purchase shares of common stock at a specific price. What we mean by dilutive shares is these create more shares of common stock, and dilutive earnings per share means let's look at EPS as if every share that can be converted is converted. You can think of this as the worst case scenario for earnings per share. It's a common thing that analysts look at. Well, how about a stock dividend? Dividend yield reports the rate of return on a dividend based on the current price of the stock. So what about dividend yield for starters? The annual dividend per share divided by the market price per share. So if the dividend is $1.25 when the stock price is 60, $1.25 divided by 60 is a 2.1% return, if you will. So you can think of it that when the company is selling at $60 per share, you are buying, quote unquote, a 2.1% dividend yield. That is different from the earnings calculation above. And finally, dividend payout ratio. Of the earnings available to common shareholders, in this case $2.50, what is the common stock dividend? $1.25, which means that 50% of the earnings are paid out as a dividend. And if you want to look at the total return to a shareholder, it's the increase in common stock price appreciation, plus the dividend per share divided by the beginning common stock price to quantify the rate you're earning as a shareholder. Remember also that you can go to Conference Room, which is a online community where I talk about accounting and personal finance. You can join for free at conference-room.mn.co. Thanks for watching, and we'll see you next time.